Understanding how stocks work is quite straightforward. However, it's crucial to clarify certain points you should consider before investing in. Even if you already know how they operate, it never hurts to recall some important aspects. Around the world, there are numerous multibillion-dollar companies generating astronomical monthly revenues. Purchasing one of these companies individually would cost a fortune. This is where stocks come into play, as you can buy them to benefit both yourself as an investor and the company issuing the stocks. This doesn't mean that all companies allow you to buy or sell stocks. For example, acquiring stocks from a local store or a neighborhood restaurant is generally not possible as these businesses are not listed on the stock exchange. The opportunity to buy or sell stocks is limited to companies that have chosen to be listed on the stock exchange. These companies, known as publicly traded companies, offer their stocks to the public through exchange platforms such as stock exchanges. Therefore, you can only buy or sell stocks, which are small ownership stakes in a company, from those listed on the stock exchange. Let me explain in more detail how this system operates. A company is composed of employees, managers, a board of directors, and shareholders. The shareholders are the owners of the company and earn profits from it. Let's imagine a company with two shareholders, each holding 50% of the company. As the company thrives and seeks funding for more robust growth and expansion, it faces the decision of how to obtain that capital. Instead of opting for a $1 million loan, which could incur considerable debt and potential long-term issues, the commonly preferred choice is to sell stocks. The two partners in this company decide to sell 40% of the company to raise more money. After this transaction, each partner would retain 30% ownership, and the rest would be sold in stocks. Imagine the company is valued at $2 million. Deciding to circulate 40% of the stocks, equivalent to $800,000, aims to avoid selling a single stock at $800,000. To facilitate stock sales and make them more accessible, the decision is made to split that single $800,000 stock into 1 million stocks. This means each stock would have a value of 80 cents. The strategy is to fractionalize the investment to make it more attractive to potential investors, allowing them to participate with more modest amounts. This not only makes stocks easier to sell but also broadens the base of potential investors. Imagine you have an entrepreneurial friend with a handmade toy store. With a lot of effort and dedication, they manage to open another store that does very well. After this second store, they do so well that they decide to open another, and so on until they have a bunch of stores worldwide. At some point, your friend decides to sell a portion of the company without completely giving it up. To achieve this, they choose to sell 49% of their company in 500,000 stocks. To do this, they take the company public, allowing them to sell these stocks to the general public. Although they sold part of the company, your friend didn't lose control, as they remained the majority shareholder with 51% of the stocks in their own company. This strategy allows them to secure funding for continued growth while the majority shareholders maintain a significant role in decision-making. It's a way of sharing the success of their company with the public while still retaining control over their business. Now that you understand that a stock represents a small piece of the company in which you've invested and grasp the meaning of owning stocks, you might be wondering how these can generate profits, how to acquire them, and how they are traded. The first thing to know is that stocks are not acquired directly on the company's website or by physically going to the company to buy them. The common way to buy stocks is through an authorized intermediary, a company with the ability to buy and sell stocks on your behalf. This intermediary is known as a broker. Brokers are companies that offer online platforms allowing you to access detailed information about your stocks, as well as facilitating buying and selling transactions. They simplify the stock investment process and provide tools for monitoring and managing your investments more efficiently. Now that you know how stocks are bought, imagine you decide to purchase 15% of Amazon stocks. Being the owner of that 15%, you would be entitled to receive a dividend of $20 million at the end of the year. A dividend is simply a portion of the profits that a company distributes annually among its shareholders. To clarify, if the company generated profits of $400 million during the year, of which $200 million were reinvested and $100 million were allocated for expansion and improvements, the remaining $100 million would be distributed as dividends among the shareholders, with you being one of them. It's a way of sharing the company's benefits with those who have invested in it. However, it's important to note that the distribution of dividends is not a constant guarantee. Sometimes companies choose to reinvest the entire or a significant part of their profits in the expansion and improvement of their operations. This means that the $400 million generated by Amazon could be allocated to various aspects of business growth and not distribute any dividends. So, earning money through dividends is one way to benefit from stocks. Decisions on whether to distribute dividends or not are made by the majority shareholders. In other words, if a shareholder owns 51% of a company's stocks, they have the power to decide whether to distribute dividends or not. In situations where the ownership of the company is divided among 8 shareholders, each with 12.5%, the decision is made through voting. To win the majority vote, more than 5 shareholders need to agree, totaling 62.5%. In a company, not all votes are equal. the value of your vote depends on the number of stocks you own. Therefore, your vote carries more weight if you own 36% of the stocks compared to someone who owns 16%. So, in the event that it is decided not to distribute annual dividends, what other ways are there to profit from a company's stocks? As mentioned earlier, stocks represent small parts of the company in which you have invested, and these parts can be sold at a higher price than the purchase price if the business you invested in shows positive prospects for the future. In other words, if the decisions made by the company you chose to invest in are correct and positive for the company's growth, the stock prices begin to rise. Imagine you are in a large square where stocks are bought and sold. This space is known as the stock market. In this market, besides stocks, bonds, commodities, and other financial instruments are traded. However, for now, we will focus solely on buying and selling stocks. Suppose you decide to acquire a stock today for $6, and the business associated with that stock begins to succeed. The value of the business grows, and this increase is reflected in the stock price. The stock you bought experiences a price increase and is now quoted at $12. If you decide to sell it, you would gain a total of $6, resulting in a 100% return. This increase in the value of stocks is known as capital gain and represents another way to benefit from your investments in stocks. The price of your stocks and the profits you can obtain depend heavily on the decisions made by a company. Therefore, thoroughly studying the company you are considering investing in is quite important. This analysis involves taking a deep look at various aspects, such as its financial health, management strategies, market position, and long-term growth prospects. Knowing the company inside out will give you the ability to more accurately assess its ability to generate profits and, consequently, increase the value of its stocks. Additionally, it will provide valuable information about the stability and sustainability of the decisions the company makes, which is essential for the long-term profitability of your investment.